Hello everyone and welcome to the Mayar Capital 2022 Annual Partners Meeting. We're happy to welcome some familiar names to the attendee list, but also we've seen some new names as well, and we're equally delighted to welcome those. For those of you who don't know me, I'm Mark Cox. I'm Head of Investor Relations at Mayar Capital. And in a moment, I'll be handing over to Abdulaziz Al-Naim, our founder and the lead portfolio manager of the fund, who will take you through some philosophical underpinnings of the investment approach from Mayar, and also look back over the last 12 months at performance and current positioning and some outlook as well. After that, our COO, Stefan Davidowski, will give a brief operations update before our senior research analyst, Aubrey Brocklebank, will outline some of the thinking between some new positions in the portfolio. But before I'd like to hand over to Aziz, I'd also like to give a brief investor relations update. One of the consistent pieces of feedback that we've had over the previous 12 months is how cumbersome the documentation and the onboarding process has been. And we've been working with our partner, Apex, the administrator, to see if we can streamline these processes. And I'm happy to announce that from today, we're able to verify identification documents either through an app online or through a video call as well. And we believe this will make the whole process much more streamlined. We've also invested in the team. In a minute, I'll hand over to our two new members of the Investor Relations team, Isabel Digby and Sophie Hamilton. Not only that, we're also investing in making it much more easy to add to your investment and also to communicate. But with the details of how to do that, I'm briefly going to hand over to Isabel.
Thanks for the introduction, Mark. Hi everyone, my name is Isabel Digby. I've recently joined the Investor Relations team at Mayar Capital. I'm going to be walking you through our additional subscription form today, which allows you to add to your current investment holdings. You can find the additional subscription form under the Investor tab on our site, where you can scroll down to Fund Info. You will then find the additional subscription form in a link where you will be led onto a jot form, which enables you to add to your subscription. You'll be asked to put in your name, your first and last names, the amount of additional investment, the date of your signature, and then sign your name at the bottom of the form.
So we hope that makes the whole process of adding to your subscription much easier and much smoother. For now, though, that's the additional subscription process, and we hope you have a better feeling for how much easier that is. We also want it to be easier for you to communicate with us, and to that end, we've also launched a Investor Relations Mayar Capital dedicated WhatsApp channel. With details of how that works, I'm handing over to Sophie Hamilton.
Hi everyone, thank you for joining. It's good to see so many of you signed up. So you may have received an intro message recently for our new WhatsApp business channel, which we believe will greatly improve your investor experience with Mayar Capital. Through providing you with a single channel to communicate from, which is secure, private, and governed by GDPR standards. Some of the benefits include speed. So if one of the team, if your dedicated relationship manager isn't able to pick up your question, it will automatically be forwarded to another member of the team who will be able to pick up your question, thus enhancing visibility. And also if your relationship manager is on leave, it will be picked up straight away. We will be also exploring further integrations down the line with our CRM to have one secure platform for all our communications with you. Please note though that this channel isn't able to accept voice calls. So the best way to get in contact with us, as always, is to email or send your question through to the WhatsApp business channel, and we can schedule a call that way. Now moving on to the Q&A portion of our annual meeting today. If you have any questions throughout the session or even now, you can type them into the WhatsApp business channel, and we will ensure the investment team will answer them. The number of our WhatsApp business account is, if you don't have it already, +4474 8080 3282. And once more, in case you didn't get it, +4474 8080 3282. We will, if we haven't got you on the system already, we'll add you to our distribution list to receive sign-ups as well, if that's something you would like. I will now be handing it over to Aziz for the next section.
Just before we hand over to Aziz, I just want to increase the amount of opportunities you have for questions and answers, which will come at the end of today's session. In addition to the WhatsApp functionality that you have, that Sophie's just outlined, you can also in the Teams chat use that Q&A function there. All questions will be anonymous, and we'll come to that at the end of Aubrey's session, towards the end of the overall meeting. But for now, we will hand over to Aziz.
I'm going to talk about a couple of topics. I'm going to get to performance updates in a little bit about the portfolio. But we wanted to talk about something more generic, which is a topic that we've been talking about quite often in the recent past. Now, a very quick way of saying it is don't look for cheap stocks. But let's take a step back and look at how we think about this matrix of what is cheap and what is expensive. So if we had a matrix of price against value, there are, in the top left, there are stocks that would look cheap traditionally. So optically, they would have a lower multiple of your favorite metric, whether it's EBIT or earnings or cash flow or book value. But it actually is cheap. So if you've done a more in-depth analysis, did a proper DCF and analyzed the business, it is also cheap. And in this quadrant, essentially, this is a classic value play where something looks cheap, is cheap for whatever reason. And we've just found that over time, as computing has improved, access to information and databases like Bloomberg has improved, this has become rare to find. And so, especially in developed markets, with very few exceptions like extreme market disruptions, it's very rare actually now that you look at something and it has a low multiple and it actually is cheap. Usually it looks cheap, but it's cheap for a reason, which is the second bottom left quadrant, something that looks cheap, but actually is expensive. And this is what classically would be known as a value trap, something where the market is actually smartly looking through the current earning power or the current book value or the current cash flow, whatever the multiple that you've used is, and looking beyond it to a future where there's earning power and the value of the business is going to get diminished. So it looks optically cheap, but actually, if you've done your proper analysis, it actually is expensive. And this is a classic value trap where it stays at a low multiple, and that multiple keeps the underlying kind of the numerator keeps declining over time. At the top right is something that looks expensive and is cheap, and I'll get that in a second because that's the sweet spot where we think we do a lot of our analysis. And then the bottom right is something that looks expensive, is expensive, and this is a classic bubble stock where something trades at a silly multiple of sales, no path to profitability or no path to improving margins, and yet for a while it trades at a high multiple. The top right quadrant is something where there's some form of hidden value, where either the real economics are being hidden by, say, a loss-making division, in the case of Google today, for example. Or you may have a special situation. You've got a temporary non-cyclical depression of earnings. So, and it's important that it's not cyclical. So it's something a special situation has to do with a company. A third scenario would be something like Vestas, which we've talked about in the past, where you've got a service business that's ramping up the value of these contracts over multiple years is already locked in many cases. But if you just purely look at the current earnings, it looks like it's a high multiple. And finally is another case that we've talked a lot about, which Aubrey later today is going to talk about a specific example, is a classic fleet maturation situation. Historically, we've talked about this in the context of retailers, where as they open more stores, as the stores ramp up, essentially as they accelerate their growth, their profits are depressed by the newer stores, but once the stores are 2, 3, 4 years old, the profitability of that store starts to show up, and the multiple is hiding that. So that's kind of the quadrant. Now, another thing that I kind of wanted to talk about, and this idea of price versus value we'll get to a little bit in deeper later and probably in the Q&A. But I want to get into a topic that has been coming up a lot, which is the issue of diversification. And often you look at this fund that's ranked number one in its category for whatever year, and you see that they're up 50, 80, 100 and something percent. There are a few funds this year that have done that, believe it or not. But when you look deeper, you see that they've been so concentrated in one or two names that we think that they're being irresponsible. Even we can know the outcome, but we know that they've taken risk that is irresponsible. And the reason that is the case is sometimes after the fact, it's easy to look at the performance and something and say, oh, this was a great pick and this is a great company. Therefore, the result was inevitable. However, just because you find something that's a great business and a great company, even if you're right that it's cheap, at the time that you're looking at, doesn't mean that it will actually translate into performance in the short or even medium term. And this matrix that we have, we took several holdings that we've owned over the past 12 years. And what we've done is we've created one of two portfolios. So the first portfolio is a portfolio that looks at 6 names out of these, which is LabCorp, Expeditors, Lowe's, UPS, Johnson & Johnson, and P&G. And if you look at the performance of these portfolios over the 9-year holding period, so you've had an equally weighted portfolio in these 9 names, all great businesses, all were relatively or trading below intrinsic value 9 years ago, you would have outperformed the MSCI benchmark by 39.2% cumulatively over the 9-year period. Great, amazing. All I have to do is pick great businesses and buy them. Well, not so fast, because actually we've created a stew stock portfolio using the same 9 names and try to simulate what would happen if you had 3 distinct portfolios, or each being held for 3 years, which is not a short-term trading portfolio. It is still 3 years. The same great companies. However, you own only 2 of them at each one of these time periods. And what we end up with is essentially a 50-50 portfolio that gets rebalanced every year, but switched within those same names every 3 years. Over the same 9-year period, that portfolio underperformed the MSCI by 26.6%. So it's not enough that you just find these great businesses and buy them and hold on forever. And I'll give you another reason in a second why that's the case. But this shows you that you can be right about the businesses, wrong about the outcome if you're overly concentrated in any one period, because even in a 3-year period, things can go against your wishes. Another twist to this question is another scenario. And this one actually is a real life experience that I have gone through from a previous portfolio, which is the predecessor fund to the Mayar fund. So in this scenario, we say, imagine a 1-stock portfolio, and you're sitting in late 2007, and like me, which is what I've done, I've looked at Nordstrom in this case, and I said, here's a well-run retailer that's investing ahead of the growth curve. They're leading the transition to online omni-channel retail, and they have legendary customer service. And it's trading at a price that I thought at the time did not reflect all these underlying fundamentals and the upside that's going to come from them. So let's say you're me and you're sitting there in end of 2007 and you said, you know what? I don't care about the short term. I'm going to go all in, 100% of my portfolio in this one stock. Well, if you've done that, this fund, this one stock fund, would have actually done, and you can see this, would have outperformed the S&P 500 by 41.4% until May 2011. So in a short period of what's that? That's 3.5 years. You've done 41% outperformance. You translate into annualized numbers, and you've generated 10.4% annualized alpha. That puts you in the top 1%, perhaps in the top 0.1% of peer groups. Woohoo, you've won. But hold on a second, because what actually happened is this. The great financial crisis hit in 2008, and Nordstrom stock fell by 80% from that starting point until the bottom. If you had this one stock portfolio, the odds are you would not have survived that decline. Your investors would have redeemed. Frankly, you probably would have given up on yourself, lost faith after losing 8%, and gone and worked in a different industry doing something else, because it's very hard psychologically to survive that. However, what actually happened in my portfolio in 2007 and 2008 is I was also diversified. And we owned names at the time that included things that did not go down by 80%. And what this diversification did, it provided us with short-term capital preservation. So we've talked a lot about in the past why you should focus on the long term, but this is actually a case where the short term also matters. That short term capital preservation kept the value of the portfolio up. So when the market went down by 38% in 2008, our portfolio went down by a still painful but a decent 25%. And we were able to sell some of the names that held up in our portfolio and rotate some of that capital, reinvest it in the ones that got down a lot more. In this case, we doubled our position in Nordstrom in late 2008, buying, I think, between the $20 and $10 a share, building up to double the position that we originally held. And the outcome of that is by the end of 2009, my portfolio, or the fund that I ran, broke even back to the 2007 highs by the end of 2009, whereas the S&P did not break even until 2013. That gave us pretty much almost 4 years of time where we were compounding our capital, making money while the index was still in recovery mode. So this is a perfect example of why diversification, even if you're right about the final outcome, can help you in the short term get to that long term. So sometimes, we've talked about this in the past, and perhaps we oversimplify things, but the long term matters, but you have to get there first. So you really have to make sure that you remain solvent when the market is irrational, because the market can be irrational longer than you are solvent if you take excessive risk. So that's kind of the message here about basically why winning requires that you stay in the game. And we've talked about this before in multiple formats, such as I think we've used the expression winning by not losing. But in the end, in order to win, you have to stay in the game, which means you have to diversify. You have to sometimes accept and put money in investments that may have a lower return, but do bring down that total risk in your portfolio. The next thing I want to talk about is performance and positioning. So this is our performance since inception. We've outperformed the benchmark by quite a bit, though obviously the past year and a half have been disappointing. 21 in terms of relative performance, and this year was still down for the year. But that is the nature of markets, and every few years you're going to have something like that. Let's look at some of the detractors for the past year. So you can look at our portfolio to see that the biggest contributors to the decline have been Samsung, Nordstrom, which we've exited, and we can get to that in a little bit while. I think there's one question that came about it. Vontier, SAP, PZ Cousins, which we've also exited, and I've written about this, and you can see the rest of the list. And the next slide shows the positive contributors to performance, led by Johnson & Johnson, Neynor, Richemont, Visa, and Wix. And again, another example of why diversification matters, because you can have this portfolio where some things go up, some things go down. This year, for example, owning Johnson & Johnson has helped us a lot because it provided a lot of stability to the portfolio. Went up when everything else went down. It allowed us over the past 2 weeks to sell down some of our Johnson & Johnson holdings and redeploy the capital in things that we think from a risk-reward perspective today are much more attractive. This is our portfolio as of last week. Largest position is Unilever. Like I said, we sold down our Johnson & Johnson. UPS, Electronic Arts, Alphabet, which I know last year we talked about how we sold down our Alphabet holding, or Google. We've rebuilt it this year as the stock price has come down. Danone, Visa, again, one we've sold down over the years, we've rebuilt again. Johnson & Johnson, PayPal, a recent holding, which I wrote about in my last threader. Bright Horizons, new holding. Aubrey will talk about it in a little while, but something that we're very excited about. And Vontier, which is something I've talked about in the past. So that rounds up our top 10. I'm going to hand it over now to Steph to talk about some of the operations updates. And there you go. Steph?
Good afternoon. It's good to be speaking to all of you again. On the 15th of October in 2021, we re-domiciled the fund from a Cayman entity to a UCITS fund that sits within Mayar Capital's own ICAV entity. I'm going to tell you from an operational standpoint the 3 reasons why this is so significant. Number 1, improved oversight and governance. Your assets are more secure than ever before. The governance structure utilises the following independent companies, all regulated by the Central Bank of Ireland. They all have aligned goals, but with revenue streams and governance that reward compliance. So the companies are obviously the investment manager, ourselves, Mayar Capital, the manager, Crossroads Capital Management, the administrator, Apex Fund Services Ireland, the depository, the European Depository Bank, the custodian, Citibank, and lastly, the independent MLRO, which is a company called Kroll that used to be Duff & Phelps. So the second reason is partnership and the ability to scale. At Mayar, we have a wealth of experience in asset management. Aziz, Aubrey, Mark, and myself each have been working in this field for around 20 years. However, best practice, technology, regulation, and compliance change all the time. So partnering with independent companies with defined roles that have the ability to scale and support is one of the main reasons we chose to go down this path. The third reason is portfolio construction and liquidity constraints. When we first thought about redomiciling the fund, one of the first questions we had was, does our fund fit into this particular fund wrapper? So yes, and so it follows that the makeup of the fund has not changed in order to comply with the particular rules that the UCITS wrapper requires. However, these rules do mean that the fund has an enforced balance that should be less risky for investors. I want to finish with a short note about Mayar Capital and what we're striving to do here. Operationally, we're guided by the following principles. Process. The investment team has a defined process that has been in place for many years, and in operations we also have defined processes that do not change no matter what the conditions. We always, no matter what the distraction is, we stick to the process. Recognition. Heightened periods of stress are expected in this business, but recognizing when these periods occur is important to ensure our attention is not affected. trust and teamwork, with an open, trusting environment where we learn from our mistakes and celebrate our successes both individually and as a team. Pressure is shared and managed. Integrity and accountability. We have strict employment vetting processes, and combined with a transparent remuneration policy that rewards honesty, compliance, and commitment. So why am I telling you this? The message I want to get across to you is that Mayar uses tried and tested processes to make consistent decisions all of the time. Right, thank you. I think now it's time for research, so Aubrey is going to speak to you.
Hi, thank you for joining us. So many of you who have followed this fund for quite a while will know that we've done pretty well out of consumer staples, and we have benefited from them for quite some time. But as we have approached this era of or this period of heightened inflation, one question that we've started to ask ourselves is, how staple are consumer staples? There's been a certain trend which has benefited us, for many years, which is that of premiumization. Now, we looked for data sources to prove this, because we've seen it apocryphally in snippets from our holdings, but the best data source we could actually get was from the US distillers, and the data is on tequila. And what you can see here in this chart is just how supernormal the super premium growth has been. It has grown at about 15%, whilst the value tequila has barely grown at all. There's the chart there. Value has barely grown at all. And the result is super premium has become such a huge share of that market. Now, this, we believe, is representative of many other stocks. They have benefited from this premiumization. So our concern is now, well, in a world of inflation, in a world of, people where people might trade down, we worry that will they trade down, and harm our stocks. Now, in addition to that, the other thing we've seen is supermarkets have increased their concentration quite significantly. So if we look at the US, in 92, the CR5, and that is the market share of the top 5 supermarkets, had a 27% share. And in 2021, they have 63%. In the UK, it was 50% in 2000, and now it's 73%. What this means is they have much more bargaining power. And they're quite happy to see people trade down into their private label goods, which will enhance their margins. And we are seeing this battleground actually take place right now, especially with Tesco and the Kraft Heinz, where Kraft Heinz have had a lot of their goods removed from Tesco's. And I believe actually Tesco's have done it again with pet foods as well. Now, we don't know what the outcome of this battle between them will be. However, this is a point where it could really start to affect certain consumer goods companies. Now, that being said, it may not affect all of them. So we continue to like Unilever. Why? Because this is still a best-in-class consumer goods business. It has some of the top brands in the world. In fact, it has 14 of the top 50 brands according to Kantar. Not only that, but it has over 400 brands in total, and 81% of those are top 1 or 2 in their market. So what that means is when they are sat down with Tesco's, they are in a really good position, because Tesco's may take one thing off the table, and they did have an argument. Unilever and Tesco's actually did have this in 2016 with Marmite, but it lasted less than 24 hours. It is much harder to negotiate against someone like Unilever than it is against a much smaller competitor. In addition to that, 50% of Unilever is emerging markets. And whilst emerging markets have often dealt with inflationary risks, the delta is much less for them. When you're going from 0 to 5 or 0 to 10, it is much more difficult to deal with than if you're going from 10 to 15. And so, they have managed these inflationary pressures for a long time in emerging markets. And then finally, the other thing with Unilever is they have activist involvement, and that could create optionality to accelerate returns. However, we have been taking action, and one example of that would be exiting our position in Henkel. Now, in addition to these concerns that I've already mentioned, there have been other issues. So, for instance, their US operations were struggling after the Sun acquisition in 2016. And they've been trying to turn that around. However, COVID and inflation have made that much more difficult. Now, we conducted several expert network calls, and we came up with several conclusions. Firstly, that the brands are just not as well positioned as competition to deal with these current challenges. Secondly, COVID and inflation have made this turnaround much more difficult. And as a result, the risk-reward just no longer favours us. Now, there are other ways, though, that you can play consumer staples. And one example is Bright Horizons. It's certainly not a traditional consumer staple, but it is very much a staple. What they do is they provide nursery care, but their clients are actually the corporations. And you can see a list of their clients. They have almost all the top 14,000 companies. And they provide the childcare for their employees. They're one of the largest US operators, and this is an incredibly, incredibly fragmented market. Now, as you can imagine, their revenue streams are very resilient because once you put a child into care, they're usually there for about 5 years. And they have very, very good pricing power. Now, that's not just because, obviously, you will pay up to look after your children, but it's also because the nature of their pricing. So an infant, you have to pay $2,200 for an infant. For a toddler, it goes down to $2,000. And then for a preschooler, which is age 3 to 5, you pay $1,750. The reasoning for this is because you need fewer carers the older they get. So for every 6 or 7 preschoolers, you only need 1 carer, whereas infants require 1 carer for every 3. But, as you may have gathered, so that's the cost almost halving, though the price hasn't anywhere near halved. But what this does for pricing power is it means if you're going from 2,200 to 2,000, you could actually put a 9% price increase through, and you wouldn't feel it as a consumer. And you can see that in the charts there, how the infant pricing is at 2,200, and then the blue bars are what you'd pay in that year. But the red is a 9% price increase for, and then the turquoise, or whatever colour that is that's the second year of inflation. So the point is you're still paying less in absolute terms, even though the company has still managed to put through quite a significant price increase. Now, it's not just a great business. It's also what we believe it to be hidden value. And there are two reasons for this. The first is fleet maturation. See, whilst they have about 1,000 centres, roughly 20% of them have been opened in the last 5 years. And it takes about 5 years to get to full maturation. And the company themselves, as you can see, have given an example of how that works. But you see, one of the reasons for this is that when you open it, you tend to get infants in there. People don't transfer in as much at year 5. So as a result, it takes all that time to fill up capacity. And so, what I've done is I've sort of shown, what the sort of estimated utilization rate is for each year. And then what we can do is we can estimate what a mature utilization actually is. And we can see that, if you have year 5 utilization of 70% and all that, the mature utilization could actually be close to 75%. Why this is important is that when we then look at the group, in 2019 they had 73.7% utilization. Well, that's group utilization. But if you can then increase that, to 74%, in total, that actually becomes really powerful because a lot of your profit is in those last few places. But in addition to that, COVID and lockdown meant that utilization actually fell very, very significantly. And so hence, when you look at it now, you see it's on an EV/EBIT of 45. But if we were to just take it back to a utilization number less, we would actually be getting it to something like 16 times earnings. And a lot of this is through pricing power. But if we then mature it, and mature that, I say, that last final bit, we see that the earnings power of this business mean that actually it could be on less than 10 times earnings. So this, we think, is a great example of a quality business that actually has hidden value because we can look through what is optically there and we can see what the real earnings are. Thank you.
Thank you, Aubrey, for that. And that brings us to what I'm sure is everyone's favourite portion of the session, the chance to grill both Aziz and Aubrey with your questions. Now, as a reminder, you can submit questions anonymously via the Teams chat function and also the WhatsApp function that Sophie has described a little bit earlier on. So please feel free to add to the list of questions that we already had. And I'd like to thank people for submitting questions throughout the session. And I think it's my job as moderator for this particular session is to summarise some questions that cover the same ground. And I think the most common question at the moment can be summarised with the phrase, "What the hell's going on?" So that's the question. What the hell is going on?
Do you want to take that?
Yeah, I'm not sure I really know. I think one of the great things about our style of investing is that actually shutting out a lot of the noise is so crucial to what we do. That it's so easy to get distracted by headlines and everything else, but actually what we've really got to do is just focus on the fundamentals of what makes a great business. And is it good value or not? And is it going to be good value in 10 years from now? Not is it going to be good value next year? Because I'm sorry, but I don't think I know what's going to happen next year. I've got an idea of a few things that might happen, but what happens 10 years? Actually, with a great business, I think we have more certainty as to what will happen to a great business 10 years from now than we do about what's going to happen to the economy next year.
My view is, I agree with everything Orby said. I think the relevant question, and the question, what the hell is going on, is obviously on many levels. So what's going on with the market? What's going on with the economy? What's going on with inflation? What's going on with crypto? Oh, sorry, we're not supposed to talk about that.
What's going on with Boris Johnson?
What's going on with Boris? There are a lot of things that you can ask this question about. I think on the market part, if we just kind of isolate them to their separate the possibilities, I think on the market part, listen, you will have bear markets. I guarantee, we've talked about this in last year, the year before. You're guaranteed to have bear markets every few years. That's just a fact of investing. And it's one reason why when you get into investing, and we've talked about this in the past, when we talk about having a long-term horizon, the issue isn't just that when analytically you need to have a long-term horizon, but you actually need to be able to stick through it. So this is, I often ask people, do you need the money in the next 3 years, or do you need the money in the next 4 years? Because the odds are there will be something like that. And the worst thing that you can do right now is liquidate. It doesn't matter what you do next year. It doesn't matter what you did last year. Just don't sell when it's down 20%. Yes, it can decline more, but the odds are the bulk of the decline is already behind you. And the fact is, if you just stick with it for another year or two, it will recover. History teaches us that. But you have to have put yourself in a position where you did not put money in equities that you need right now. You did not lever up to invest. All of these things, these structural things that you have to put yourself in matter. And then the other aspect to it is psychologically you have to have gotten into this situation prepared. And not everyone can handle a 20% or 30% or 40% decline. In fact, we're going to have over an investment career or investment period until retirement, you will probably have a few, or at least a couple 50% declines from peak to trough. They do happen. And if you can't handle it, it means you have to diversify. You cannot put all your money in equities. You have to own. I know fixed income is down this year, but it still would help if you had some fixed income, if you had some money markets, you had some real estate, whatever it is that you're in. There will be periods where everything goes down, but it helps if you're diversified, and it helps if you're not levered, and if it helps, and it's essential actually that you don't need the money, so you're not forced to sell right now. On the economic front, I think it's the same story. I think the U.S. The count is different depending on the country, but you're looking at 13, 15 recessions just since World War II, a bit more if you go back. This is just a fact of life. You will have recessions. Economies go in cycles. Are going to have recessions. Is it different this time? On one hand, it's always different this time because each one is slightly different. It's caused by different things. This is why you can't fight basically the last war. But on the other hand, it's the same in the sense that most of the time, all you have to do is just wait, and eventually these things self-correct. And I would argue that recessions are healthy because they help correct some of the excesses that happened during the boom times. Inflation is obviously a new thing in Europe and the US this time because we haven't seen inflation this high in a while. But it's not something we haven't seen ever, even in the US and in Western Europe. And we do see it in other countries all the time. In the end, usually the way out of it is a lot of pain, economic and especially kind of on the labor force. And eventually things do correct, but it is a painful process. And there's no, can we go back and say, what if this is done? Yeah, there are 1,000 things. What if COVID hadn't happened? But we also don't know what the alternate reality is. What if no stimulus happened during COVID? It could have been worse than now. We don't know. So it's easy to look back and say, oh, of course, now that we know what happened, this is the wrong course of action. But the alternative could have been worse. This may have been inevitable, the least worst outcome of many coming out of COVID.
And I think you mentioned there, don't sell when the market's down. That's one of, if you can help it, of course, don't crystallise those losses. But there's, I guess, a flip side to that is to answer the question, is now a good time to be adding to your allocation to global equity? I'm mindful previously you had a slide with a stock down 80%, which of course is a stock that went down 60% and then halved again.
Yeah.
And so, yeah, can we answer that question? Is now a good time to invest? Should people continue to average in as the market goes down, as well as we advise, go up? It's interesting to hear your views on that.
So I think, to me, answering that question is there are two ways of looking at it. There are essentially two different questions. The first question is, if I buy now, will my portfolio go down in the short term? And I think the answer is very possibly. I don't know what the probability is, but it's certainly possible. Is it probable? I don't know. But it's certainly within the realm of possibility that you can see another 10, even 20% down from where we are. It's certainly possible. It's not something that hasn't happened in the past. But I would argue that that's the wrong question to ask. The right question is the second one, which is, if I buy now and I hold on for the long term, am I going to have a decent return over the next 5 years, 10 years? And I think the answer to that is yes, I think you will. But that does not mean that in the short term you won't experience some pain, because that's unknown. And if you wait and you don't invest now and you say, I'm going to wait, maybe it gets worse. Well, if the market recovers, you may also miss the opportunity and end up buying at a higher price. So in the end, if you have money now, I think it's a good time to invest. So I'm personally trying to invest as much as I can, any dollar that I save. Doesn't mean that I don't think it's going to go down. It could go down. I don't think it matters 5 years from now. And if it does go down in the next 6 months or 1 year and you have extra cash, well, that's probably going to be an even better opportunity to buy. So it's very hard to forecast whether a better opportunity will exist. But this one is certainly a good one.
And I mean, you mentioned you personally allocating to the global equities and the fund, of course. But what about the fund itself and its positioning? Does that reflect the fact that you see potential opportunity at this level?
Yeah, absolutely. I think the current, we've been fully invested for the past 2 months. At any day, you can look at our portfolio and there might be 1 or 2% cash, but that's often just friction entering positions or exiting positions and things like that. And I think there are only 2 times in the past 5 years that we've been fully invested. One was in the absolute depth of COVID, which again we thought was a great buying opportunity, and the other one was in December 2018, where also the market was down 20-something%. So I think as a rule, if you do nothing but every few years you accumulate cash, every time the market is down 20%, you go buy an ETF. Ideally, you'd buy our fund, but if not, go and buy an ETF every time it's down 20%. I think over a lifetime, you'll do very well.
Okay. And thinking back to not only the example, but a stock that has come up at previous annual meetings, namely Nordstrom. It's something that people have asked us about in the past, and we've defended that. This time, there is no defence of Nordstrom because it's not in the portfolio. So would you like to add some colour to that?
Yeah, I mean, sadly, this it's been a painful experience, and no one enjoys painful experiences, especially me. I think there are 2 cases here. I think I touched on it in the letter, and maybe I'm sure Aubrey has more to say. But since it's mainly my fault, I should answer first. I think there are 2 aspects, 2 things that happened here. But to sum it up, at the time that we sold it late last year, after the annual meeting, I think is when we did, the risk reward just made no sense. The business, the competitive positioning of the business had weakened. Both in an absolute sense, but especially relative to some of its competitors. So I think it used to be well ahead of its competitors, and the competitors were way behind. And during COVID, a lot of the competitors caught on, and Nordstrom probably fell behind a little bit. And Nordstrom fell behind during COVID we think for two main reasons. The first reason is they're essentially the mix of what they sell going into COVID was much more heavily towards event wear, suits, gowns, shoes, all of these things people stopped wearing during lockdowns and were just sitting on racks in Nordstrom and nobody was buying them. And so what ended up happening is you had excess inventory that sat on their balance sheet for 2 years, and in many cases went out of fashion. But most importantly, you had all that working capital that's just sitting there with zero turnover on it. And then the other thing that is related to that, but also a function of, and which is my second point, they did a financing round right before, kind of in mid-March, right before the Fed intervened, and they had to borrow at a very high rate. Their competitors at the time just could not borrow. And had the Fed not intervened, the competitors would have gone out of business. But the Fed intervened and their competitors were able to borrow at very, very cheap rate. Nordstrom had already locked in more expensive financing. And unfortunately, that meant that a combination of a high level of debt and expensive debt relative to competitors and essentially lower sales and inventory turnover over those 2 years meant that they came out of COVID with a much, much worse position in terms of merchandise and balance sheet. But then also the competitors who were behind in terms of omni-channel retail, in terms of how well they did online selling, had this great opportunity with their backs to the wall during the first lockdown to really figure out how to do online. And they had to do it quickly, and necessity is the mother invention. They were able to catch on with Nordstrom faster, especially because they were selling the things that people wanted to buy, the sweatshirts and sweatpants and so forth. So basically at the end of it, it just ended up being a balance sheet that's a lot worse. So even if the business value is intact to some degree, just the debt is so high that the value is going to accrue more to the debt holders than the equity holders. And then just at the time, we just found that there are better things to put the money in. I still think that if they can sort out the balance sheet issues, it's probably going to emerge and do okay as a business. But I think for the equity holders, it's just really hard to see how they can get out ahead from such a tough situation. I don't know, Aubrey, if you have anything to add here.
Yeah, I guess the only thing I'd say is, I mean, you did touch on it, but if we look back at our original thesis, it was that they were going to be the category killer. When you looked at the competition, it wasn't just that they were behind in online. They were really struggling and they were all over the place. Yeah, and whilst they were failing and, starved of cash, that was such a great opportunity for Nordstrom. But then, as you said, they got cheap financing, which enabled all those retailers to fix their balance sheets. But some also went bankrupt and then restructured. Yeah, and by doing that, you just reset the playing field. And, we like businesses that have a really clear advantage over their competitors. When it didn't, the thesis was broken, so we had to exit.
Okay, we've got another question related to Nordstrom, but before we get into that, I'd just like to remind our attendees that to ask a question, you've got two channels to do that through. First is the Q&A session in the Teams link that you're viewing this through, but also the new WhatsApp business for Mayar Capital as well. So if there are any additional questions, please use those channels to ask them. But I think this is more to do with process and Nordstrom's role in that. We've often talked about the checklist and how it's a good way to review things that haven't worked out. Have there been any additional changes to the process, or as you review the decisions that you made regarding Nordstrom, has there been any change to the checklist, or is it sometimes it's circumstances and events that, to use a political phrase, that really show that this ultimately was not the best decision?
Yeah. It's a hard one. I think the checklist is and always will be a living document. And every time we do a post-mortem on something that we've sold, whether it was a success or failure, we do look back and think through what did we get right? What did we get wrong? I think this one is a tough one because there are lessons to be learned from it. Some of them have to do with the importance of balance sheet and competitive positioning. And those were already in the checklist. I think if there's one thing that I certainly underestimated is how quickly the competitors armed with cheap financing and zero brick and mortar sales because there was a lockdown, that extra incentive caused them to really figure things out. And it's something that you see them and they were struggling with it for so many years, unable or unwilling to put in the money or the resources or figure out how to do it right. And I still think Nordstrom is better than them overall, but it's just the gap has just shrunk so much because of the conditions. I don't want to learn the wrong lesson out of it as well, which is always tricky with something like that. With, for example, the lesson cannot be buy a retail that sells sweatpants instead of nice clothes, right? That is very unique to the circumstance of where this has failed. And but I don't know. I mean, if you've got any thoughts on this?
I think in many ways this is an example of the process working, because we're not going to get it right every time. The question is, can we recognize when we're wrong, and when things have changed, as it Keynes, when the facts change, I changed my mind. Things change, we exit. That is our process.
No.
And we have to do that because, I mean, one of the most devastating things an investor can do is chase losses. That when something changes, you get this thesis drift, and you go, oh no, well I still like it, but oh it's still cheap, and that is just a way to bleed money.
I think that's a very good point, and I think what happened with Henkel as well is related to it in the sense that sometimes a situation could be heading in the right direction, but then a series of events can really throw things off course, and when that happens, you just have to admit that you may have been right at the time that you invested, knowing what you knew at the time, but what has unfolded since then has just meant that, I don't know, I mean, things happen. and you just have to deal with things as they come. And you're not going to know ahead of time every single thing that could happen. And you just need to rewrite with the odds. And this is a perfect example where we didn't lose our shirts as well. Yes, we lost some money, but it wasn't a complete disaster. Again, another reason to diversify.
Well, staying on the subject of diversification is, or at least somebody was listening and watching the slides as well, is around the positions in Neynor and Vistry. One is one of the biggest detractors. One is the biggest contributor to performance over the year. They're in the same sector, although slightly different exposures for both. Maybe you could explain that first. But is this an act of diversification, or do you like both individually? Is it part of a basket? How do you view those? The home building sector.
Let me unpack that question a little bit. I think the person who asked it is assuming that when you diversify, you're buying something that you don't like. But I don't think that's the point here. You diversify by owning many things that you do like. I don't think you can know ahead of time. You may know, I don't think you can know, at least I can, what is the number one favorite idea. I could probably guess what my top 10 ideas are, but I might still own another 10 that may not be as good as the first 10, purely through the lens of upside, because from a risk-reward point of view, from a portfolio point of view, they're still good investments, and they add value overall to the portfolio. I think in the case of Neynor and Vistry, we do like both, and we've talked about the industry before. A case of diversification, perhaps. there are two things going on. One is we own 2 home builders, but then we also own 2 home builders in 2 different countries. And there's a third one, which we could get into, but maybe if we have time, is that Neynor also, both Neynor and Vistry have kind of divisions in addition to their mainline building. In the case of Vistry, their partnership business. In the case of Neynor, their rental, the property rental business, where there's something different going on. But that aside, I think we like both. I think the geographic diversification between 2 countries means that we're not exposed to necessarily the same risk. There are some common things that are underlying. So rates are probably going to go up in the UK and in Spain or the Euro area. So that's happening for both. But there are more nuances to individual markets, especially where they are post-GFC and the dynamics of the individual countries that are different. So the risks are different, and that diversification is good. Neynor did better this year. Next year, Vistry might do better. But you will also see that they're both relatively smaller positions. So because they're still exposed to that common rate move risk, they're not 5% positions each. So we do think of them as a related but not identical investments. I don't know, Aubrey, if you...
Yeah, I mean, maybe I'll quickly touch on some of the other things that are going on with them, because they do have some pretty idiosyncratic features that a lot of other home builders don't have. So you mentioned the Vistry partnerships. That's where they build properties for the councils, UK councils. And so unlike other property, you don't have a land bank associated with that. But therefore it's actually very capital light. And the councils will prepay that. And so on some of their projects, they have absolutely obscene returns on capital in excess of 100%. And this is just not being rewarded in their share price. And we know that there is a shortage and chronic need to build in this country, especially at the low end. So we really like that there. Whereas Vistry, as you said, it's got the rental portfolio, which again is just Neynor, yes, which is not being reflected. But in addition, Spain also has some really nice little features. Like, we happen to know that they're trying to go to a more capital-light model of using options, or paying deposits, in the same way that NVR do in America. And what this could mean is that they'll actually be able to compound at much greater rates going forward. So, yeah, I think we really like both. And it's just great that we can also then have some diversification, geographic diversification with it as well.
Yeah.
Okay, thank you. I've got a couple of questions on performance, but more generally and also specific for the last 12 months. So if you'd like to ask a question, just a reminder that you can do so in the chat function in Teams and also through WhatsApp. And I think one of these questions relates more generally to the type of performance profile one should expect over time, given Mayar's investment strategy. So if you look at the performance over time, you'll see that often we slightly underperform or keep up with the market in when it rallies, but when the market falls, you tend to preserve more capital than the market. And I was just wondering if you could highlight some of the reasons for that.
Yeah, I do think this is there are 2 reasons why this has happened in the past, and there are probably reasons why they will continue. There is a small contribution from how much cash we have at different points in the cycle, and that's a function basically of where valuation is across the market. So you'll see that today we have very little cash, and when the market is up, we'll probably have more cash. But there is an element of cash drag in the, especially at the later stages of any rally. That does hurt performance a little bit, but that actually is a smaller contribution to the overall performance contribution. I think it's a case of, we've talked about this of being the tortoise and the hare and just what we tend to invest in usually is relatively more conservative. We take a more conservative approach to even the things that we select. And what we talked about earlier, we will own names. I mean, you'll see that we've owned Johnson & Johnson for many years. Johnson & Johnson, since we've owned it, have done a little bit better than the market, but I think it's only compounded by a tiny bit more. But what it does is that it gives a lot of stability in down markets. Unilever would be one that would do the same. These kinds of holdings add to that overall portfolio, give us stability. And back to what I talked about earlier, it keeps you in the game in the bad years. And I mean, one good way to see that through our numbers is to look at our capture ratio. So in our fact sheet, you'll see in the stats, there are two numbers. One is called an upside capture ratio, and one is called a downside capture ratio. And bear with me on this because an upside capture ratio basically looks at every time the market is up, what has the fund done? And averages that over time. So when the market is, so if you look at our number, our capture ratio is in the mid 90, let's say it's 96 or 95, can't remember what it was recently. And what this says is that every time the market is up 10%, this is monthly, so it probably isn't 10%, but let's just say 10 for the sake of math. Yeah, easier math because I'm getting old, I can't do math as fast in my head as I used to. So every time the market is up 10%, you would expect on average, or at least this was happened the past 11 years, we'd be up 9.5 or 9.6%. So we'd be underperforming the market by a little bit. The other capture ratio is called the downside capture ratio, and it looks at every period, every month the market is down, and looks at how our portfolio has behaved in these periods. And on average, every time the market is down 10%, our portfolio is down something in the mid 70s, so 77.5 or whatever call it. So you'll see that in general, both are up and down, are less volatile than the market. But what's the most important thing is that the upside capture is higher than the downside capture. Because the market is volatile. If you're only doing this for one period, 1 month, you'd say, I'd go for something that goes up more than the market. But in reality, because the market is volatile, you can win by doing one of two things. You either do better than the market in upside and not lose too much on the downside, which it's possible. I'm not saying it's not, but that's not how we invest. We'd rather flip it and basically win by not losing. So keep up with the market, do a little bit worse in up months, but then protect our capital in down months. And over time, as the market zigzags, that accumulates into a positive outperformance over the benchmark. And so this kind of investing, I think, does two things. That keeps us in the game, allows us to sleep better at night, and I think it's a feature of kind of our conservative approach to investing overall.
Okay, and I'd like to tie the more recent performance with, say, the growth in AUM, particularly from 20 to 21. We haven't seen AUM growth from a firm level this month, but this year. But of course, the market is down. We're more or less stable. Is that a contributory factor to the relative underperformance from last year?
I mean, I don't think so. I mean, there is a scenario where that would be the case. And that would be probably if we'd grown. So we've basically between the beginning of 2020, I think in March 2020, we hit 100 million. In March 21, we hit 200 million. And now we're like at 250 or 260, whatever the number might be. If we had gone from 1 billion to 3 billion, I would argue there might be some contribution from size, because at that stage, maybe there could be some holdings that are less liquid that would be shut out of. But we're still relatively small to the market. And I would argue, actually, even if you're bigger, it's not a guaranteed outcome, but it's something they have to plan around. And you have to, you can't just keep doing things the way you are. If you go from 1 billion to 3 billion to 10 billion. It does get harder and you do need to do things. But I don't think it's an issue at our size. I mean, if you look at our portfolio, I get a report regularly every week from our ops team that analyzes all of the liquidity of the fund across all portfolios. And pretty much most of our holdings going in or going out takes 98% of it, so it takes less than a day. So that's not a contributing factor to that underperformance. I mean, we've talked about 21 last year in our annual meeting. The biggest detractor has been that we did not own a lot of the tech names that went up a lot, and we had a lot of cash. So we sold too soon, and we didn't own the things that went up in price. And then kind of into the beginning, a couple of first months of this year, energy also hurt us. But you can see that the portfolio performance relative performance at least has improved the past few months, and we're outperforming now, albeit we're still down. But I don't think size has anything to do with it.
Well, let's stay on size for a moment, because there has been AUM growth over the time period we're talking about. But is there any additional benefit to, in terms of research resources or management access, or something that you're able to do today that you couldn't do, say, 5 years ago?
Oh, definitely. I think there are several things that have come with size. If you want to look at it even just a little bit longer than 5 years. So when Aubrey joined in 2015 or 2016? 15, and in November 2015. Well, for one, it's fun to have him around. But from a research point of view, having someone like Aubrey in the team allows me to bounce ideas off of him. He's great at challenging me. He's great as being a devil's advocate, and hopefully vice versa, me and him. And so I think that added value, that I would not have been able to build a team at Mayar had we not grown in size. I think in the more recent past, what it allowed us to do is get the second generation of talent into Mayar. And what that has done, it basically allowed us, well, for one, they're much better at coding and math than Aubrey are right now. So that's, I mean, I don't know if they're watching, but they're really smart.
We can edit that out.
We can edit that out.
Right, yeah.
I think their addition does two things. One, it does give us more resources to dig deeper into opportunities. It allows us to look at multiple things at the same time. So instead of looking, we could have several things that are kind of running in the background that Felix and Jack are working on, while Aubrey and I are working on something that's more pressing, that's immediate. And then the other thing, I do think that it makes the team discussions and debate, the variety of backgrounds and opinions that everyone brings to the table, does make it a much more deeper discussion. And then the other thing is it does bring different kinds of talents to the table. I don't know, Aubrey, you lead this team, so maybe you'll have...
Well, I mean, look, as you mentioned earlier, us getting older, sort of the mental arithmetic, performance does decline. So it's great to have some young people.
Only 10 fingers.
I think we've got 20 between us.
No more than 20 times 30.
Oh dear. But yeah, no, it's great having them, and because one of the realizations I had a while ago is that, I think 80% of stock returns probably come from 20% of the work you do, but 99% of your losses come from the 1% that you miss. And so the trouble is, we have to do the whole pyramid. We have to work on everything. But at the same time, you want to focus your efforts on the 20% that are going to, really add value. And on the rest, you just need to make sure it's covered. So that's why it's so good to have some juniors who can actually help you, especially with that, to really try and make sure that you just don't miss what that 1% is. And then that sort of frees up a lot of time to actually focus on what is it that's really going to make a difference to this business.
Yeah. And I think on the business side as well, it does two things. One is it allows me not to spend so much time. I mean, I used to review every single NAV myself. I used to prepare a lot of things myself. It frees up my time to focus on the portfolio, focus on investing, work with the investment team. And we have Steph, who is great at taking care of all of that stuff, and I don't have to worry about it. So that operational robustness gives me the freedom to know that someone is taking care of it, and I don't have to worry. But also on the client side, having Mark a few years ago and then having his team now means that I'm not worried about how well we serve our partners and our clients, because I know we've got the capacity and bandwidth to do that. So I think it's better for our clients from a service perspective. It's better for the operational robustness, frees up my time, and I think it's great in terms of investing. The one big thing actually on the investing side that I think has really made a difference is it gave Aubrey and I extra bandwidth to think about what's next. How do you want to improve things? What technology can we invest in? How can we better improve the process? And all these things we...
And as you said, they can actually code and program
and they
do
can,
things that
we can't do.
Yeah.
Okay, I want to sort of link together three questions that we've received.
Oh boy.
Let's see if I can do it first before you answer. And I think the reason for this is that we often talk about the bottom-up nature of our investment process, how macro is unpredictable. But at the moment, we have a macro event in Europe, namely the conflict in Ukraine. And I just wanted to ask you, first of all, how does that impact on, say, global supply chains, which a top-down macro issue, affect your thinking and affect your analysis? Because even though we hope this is not a long-term conflict, it still has near-term impact. So mainly thinking about the impact on the global supply chain. And then when you think about the individual stocks in the portfolio, let's say Vestas, for instance, there's been a move away perhaps or back towards coal as we look to change the energy mix in the short term. Something like Vestas, the wind generation turbine company, is clearly impacted by that. And then we have some UK consumer-facing names which could be impacted by the cost of living and inflationary pressures, putting pressure on household budgets and spending moving away from discretionary to the staples that perhaps Aubrey mentioned earlier. So that's a very long question with lots of bits in it. I guess that gives you the opportunity to ask it however you want. But I guess at the heart of that is when there are these big, significant macro top-down events, how does that feed into what is essentially a bottom-up investment process?
Yes. I think one of the issues that I have with people when they talk about bottom-up is I think there's a difference between saying macro doesn't matter and saying I can't predict what macro events will happen. And I think that nuance gets lost a lot with many investors, many value investors as well. And I think often it's not necessarily deliberate, but I'm sure I've said in the past where when we say, not in the past, probably in the past hour when I said it's a recession, there are going to be many recessions and I'm going to recover. It doesn't mean that it does not matter, but where it matters is often whether you can predict it, but also how it impacts the businesses that you're analyzing from the bottoms up. So macro absolutely does matter, but the most important way it matters, so macro is two things. One is something that is cyclical and one that is structural. So the structural macro always matters to the company. Something where, think of if you're looking at an oil company, you have to actually think about what macro is going to do structurally over the next 5, 10, 20 years. It's just stupid to say that it doesn't matter. The cyclical bit matters in certain scenarios. The case of Nordstrom that we just talked about, where there's an impact on balance sheet and actually that cyclical impact put it really behind is a case in point where a temporary event has hurt it in the long term. Henkel is another one where you already had a turnaround going into a downturn and that hurt its ability to recover. So it does matter, especially when it hits the balance sheet. It does matter where sometimes it means that management cannot keep going on if they lack resources or if they take their eye off the ball. The question is, can you predict? Well, I think at the individual company level and industry level, you probably have a better way of figuring out, you're not going to be successful 100% of the time, but you're going to have a better odds of figuring out the impact on short and medium term macro events on the individual business, on the industry, and the ability, especially of the competitive landscape of that industry. The things that I don't think necessarily matter in the long term are things like this interest rates going up or down in any short period. But again, if you're looking at housing, it's something that certainly need to take into account when you're looking at valuation, for example, and the impact. You use book value, but what's book value and things like that. On the question of Vestas, for example, I think the sad and I'm not. I don't want to kind of dismiss the human cost of this situation. But if you purely want to focus in on the energy aspect of it and the environmental aspect, it's unfortunate that it is causing many countries to start to use coal because they don't want to use Russian gas. But I think that in of itself is a short-term outcome. I think in Europe especially, you see that higher fossil fuel prices and the conflict has actually accelerated the demand into renewables, especially wind. The main deterrent to Vestas delivering 5 billion megawatts tomorrow is that you just can't build it quick enough. You can't. There are supply chain issues. There are capacity constraint issue from suppliers. There are capacity constraint issue in their own in terms of production capacity at Vestas, and Aubrey could talk more about that. And then there also just takes time to plan, fund, and deploy and operate a wind project. So it cannot be switched on overnight. But I think, if anything, whatever the trajectory was pre-Ukraine conflict, instead of, in terms of the forecast for wind over the next 5-10 years, in my opinion, it certainly accelerated post-Ukraine war. And there was one thing.
Yes, the UK inflationary pressures on some of the more discretionary names in the portfolio, perhaps.
I struggle to see how in the short term it doesn't hurt them. I mean, if you've got 10% of your income that's discretionary, that you're using on discretionary things, if inflation goes up by 10%, there goes all your I'm fudging the math, but there goes all of your discretionary income, and all your money is going to basic. So there's no doubt in my mind that will hurt them in the short term. But I think it's one of those things where in the in the medium term and long term, that's the sort of thing that probably won't matter as long as the balance sheet is intact. And it's one of the things, for example, that we liked about Wix when we bought it, and that they had a lot of cash on their balance sheet, and they went into this from a position of strengths. So even if there's some short-term pain, they're not going to have their back against the wall and have to damage their balance sheet. Or maybe you want to talk about that, and maybe, I don't know if anything else on the wind or...
Well, I mean, I think I'm going to say something really dangerous, which might jinx us. But I think we could actually be going into a proper stock pickers market now.
Oh boy. Famous last words.
I know this is something that sort of every investor seems to say every year, and it's still flows that seem to dominate returns. But the reason I say that is that there are pressures, there are difficulties. But what that hopefully should do is actually separate the good companies from the bad companies. Yeah. Because, as you say, when you have inflation, if a company cannot pass that inflation on, their margins get hurt. Simple as. Also, there will be demand destruction because, as you say, if your discretionary income is reduced, you cannot buy as much volume. So you have a declining volume and you have declining margins, but that will happen to bad companies. Great companies that can pass on prices, that can maintain their cost base as well as possible, actually should be able to do quite well. If not actually excel. Because again, when you have difficulties like this, you actually clear out the dead wood. You clear out capacity that is where capital has been misallocated. This is one of the problems of ultra low interest rate environment, that you get misallocations of capital and you get a lot of startups that probably never should have happened in the first place. When you clear them out, then all of a sudden, those that are strongest, those that survive, actually do so much better. So, in many ways, as painful as it could be and as horrible as it is, this actually could be a great opportunity for great businesses. Hence, as I say, I think maybe this actually does become a stock picker's opportunity, a stock picker's market. Now, in relation to the wind, you're right, you can't just switch on. But one of the things that's actually quite nice about wind is that it's much quicker to do that than, certainly than a nuclear power station. As much as, certain politicians might want to talk about nuclear, the trouble is, I think, there was a recent article about a new plant that was going to be deployed, and maybe it will be operational by 2050, if they start now. Wind can be done in a few years. So you can build a wind farm in a few years. So you just sort of think, come on, that has to be at the forefront of decision makers' minds. And I think that covers.
Yeah, I'm actually a big fan of nuclear. I think I think it's very helpful to have it in the mix. Like Orbis said, it'll take a lot of time, even with the newer nuclear, smaller reactor kind of technologies. It's going to take a lot of time. And wind is great because it's also cheap in a lot of places in the world. It's a lot cheaper than other sources.
Yeah. Okay, we're coming towards the end of our allotted time, so there's only a few more questions to get through, but if you do want to get under the wire, remember it's in the Q&A of the Teams chat and via WhatsApp. And as I say that, I'm going to blame Aziz for this question, which of course, crypto. We can't go through a session without having at least a word on that, and I think we've to some extent been pretty pessimistic on the role that cryptocurrency plays as an asset class. At least, maybe a little bit more positive on the technology it could possibly leave behind. But of course, over the last few weeks and months, we've seen that not even crypto is immune from market volatility. So just a few thoughts on that, and then we'll probably finish on some more portfolio related questions.
Listen, while I do think that crypto is most likely worthless, it doesn't mean that it will trade at zero. Or at least not all of it. My favorite analogy for crypto is something that my son Faris is obsessed with. He's just about to turn 9. He collects these cards called match attacks. And there are many equivalents to this. Match attacks is...
like a baseball card?
It's like a baseball card, but this one has football, soccer players on it. And they trade it. He trades it with his friends. You buy it. I think a pack is £1, and then each player will have strengths and speed, and I don't know anything about football clearly, but things like that. And to me, whether it's baseball card or for that matter, Pokemon cards or match attacks, people are willing to pay for them. Granted, they're children, but they're willing to pay for them. And actually, many of them do keep their price. Even adults collect them. Personally, my personal opinion is that they're worthless. But people do get utility from them. And when there is some utility, people can assign, especially with collectibles, people can and do assign a non-financial value. Not everything is a financial asset that has to be worth something in a DCF. Sometimes, people just like something. I don't know, what's the intrinsic value of a beautiful flower? I don't know. You can't get a tulip maybe. You can't put and That being said, I did make this point previously that crypto is akin to match attacks and that it's useless in terms of just purely trading them. And my son pointed out to me that actually match attacks is more useful than crypto because you can actually play a card game with your friends with it, which you can't do with crypto. So in addition to its collectible value, you can also play a card game. I wouldn't be surprised if Bitcoin trades at a non-zero value. But I don't think, to me, it's not a financial asset that's investable. And I mean, there's someone who's going to very quickly, I'm sure, jump and say, well, neither is gold. And I agree. And I think also gold has no intrinsic value. Gold equally has collectible value that collectively, as we decided, is nice and shiny and we like it. What gold has over crypto is 3,000 or 4,000 years of history. But it's the same thing. It's not a productive asset. It's something that we hold and some reason assign value to. But in the end, it's worth what someone thinks it's worth in any moment in time. But then it's got that kind of history going for it compared to some of these cryptocurrencies.
One of the things that's interested me about crypto is just how many really smart people are involved in it. But it hit me that, you may be a really smart tech guy, but actually to understand Bitcoin, you need to understand the technology, you need to understand currencies, and you need to understand asset classes and capital markets. Financial markets. And actually very few people have all those 4 skills, but they're still very, very intelligent people. And the trouble with really intelligent people is that they're some of the last people to admit that they're wrong. So, and I think that's why it will not trade at zero for a very long time, if ever, because there will still be enough people, even if it does completely crash again from here, there'll still be enough really smart people who will refuse to accept they're wrong.
I mean, there's that, and then a lot of people are just fascinated by the technology of it. And people often just want to trade things. I mean, people gamble. They go to casinos and gamble as well. That's equally stupid. But they do it. They get utility out of it. It's just
Did I ever tell you about the sardines in World War One?
Go ahead.
Sardines achieved astronomical values in World War One, and held to be a real delicacy. And people were trading them for just stupid amounts of money. Now, one young soldier who was about to go over the top, and he sort of takes his life savings and decides, I'm going to have some sardines before going over the top. He buys them, he opens them, he has one, it's revolting. He goes to the guy who sold it to him, look, they're off, it's revolting. Ah, but those aren't eating sardines, those are trading sardines.
Exactly. Yeah.
Well, thank you for that anecdote, and thank you for the question, which gives us our regular diversion into crypto land.
I mean, we could go on forever.
If there are no more questions, there's one more I'd like to talk about the portfolio, and perhaps it's we've had what the hell is going on, and some difficult questions regarding the macroeconomic environment, but within that, there must be some companies, and we often talk about the strength of brands, for example, that can survive or maybe do well in such an environment. Is it your impression that the portfolio contains a number of these names? Is it 1 or 2? Is it 20? Be good to understand the robustness of the portfolio from a brand and from a business and from an industry perspective, rather than just from equities and markets.
I mean, there's more to it than just the kind of inflationary aspect and kind of the short-term aspect to it. But let's take them one at a time. I would say that, we've been looking at portfolios for quite a while, and we've been quantifying the quality and upside to downside in our portfolio also for a while. And with very brief, maybe exceptions, mainly kind of during the depth of COVID, we haven't had a portfolio that is as high of a quality as we have now and has as much upside, we think, as we have now. like I said, COVID may be an exception, but I would argue that the last weeks of March 2020, yes, the portfolio had higher upside, but there was a real chance that we were all going to die. I mean, it was at that time we didn't know what was happening, and the risk, the existential risk, not just to the economy, but to us as human beings, was much higher. I don't think this is what's happening now. So that aside, I think this is one of the highest quality portfolios and most upside that I've seen in a very, very, very long period of time. I think if you want to look at it purely through an issue of robustness against an economic cycle and inflation specifically, I mean, this is something that we've always thought about. We've always talked about pricing power, the ability to withstand shocks. It's something that we've looked at always. I think in the good times, the ability to have pricing power, strong balance sheet is a way to grow and compound over time. This is a situation where these features help you, at least from a defensive point of view. So in a low inflation environment, the pricing power will help you grow faster. In a high inflation environment, it helps you protect your margins. Now, it won't happen every quarter, every month, or even every year, but it does mean that I think you're better protected than something that doesn't have those features. I mean, there are cases in our portfolio, think of Visa and MasterCard, Brenntag and chemical distribution, PayPal, where you do have almost a pass-through where inflation actually benefits them because the price goes up of whatever they're selling, the volume multiplied by price, multiplied by their take rate, they benefit from inflation or at least don't get hurt as long as their costs go up at the same rate. But there are, in general, if you own things that have a competitive advantage, that have a strong moat and a strong competitive position in their industry, whether it's through brands, through patents, through technology, or network effects, these companies are going to be the best positions to pass on higher costs to their customers. They won't get it 100% of the time. They may not be able to do it immediately at once, but over time, they should be able to do it. Aubrey?
Yeah, well, look, I think all of our businesses will do well in the long run. It's just a matter of who does well at what period. And they will all do well as a result of the difficulties. But again, it's, in many ways, I guess we've diversified our sort of time horizons. So as you said, the Visa and the MasterCards will do well out of inflation to begin with, because as inflation goes up, if the cost of goods goes up 10%, the amount you put on your Visa cards goes up 10%. Whereas a business like Vestas, that has slightly different inputs, but it has inflation-linked contracts on the service side, so that will continue to grow. And then, Unilevers of the world, they will also win, but that might take longer because you might have short-term pain. But as was mentioned before, as some of these, sort of startup brands, get killed and, fall by the wayside, you're then left, with the category killers, you're left with the best that survive. So it's really just about time horizon. I think they'll all do well, just not at the same time.
Yeah.
Okay, well, thank you very much for that. That brings us to the end of the sent-in questions. So it just leaves me, before I hand back over to Aziz for some closing comments, to thank you all for joining today. A recording of this session will also be available in the coming days. I'd also like to thank our clients and supporters and partners for supporting us over what is now 11 years, but particularly over the year to date. You continue to support us, you continue to make recommendations on our behalf, and we feel that obligation as stewards of your capital very personally. And Aziz has built a team specifically constructed of people who do feel that obligation at a personal level as well as a professional one. So on behalf of all the team at Mayar Capital, we want to express our gratitude for that continued support, and we hope we can rely on it in the future as well. But for now, I will hand back over to Aziz with just some brief closing comments.
I want to ask you all, and thank you all for turning up, for asking the questions. I think the quality of the questions is getting harder every time. It allows us to challenge. It challenges us, but I hope that we do our best to answer them. And if you miss the opportunity to do it now, please feel free to reach out to any of us with your questions. I want to thank Mark, Sophie, and Isabel for putting together the event this year. I think every year as a team gets bigger, I hope that we're adding more value and improving the quality of this event and making it not just more informative, but also more enjoyable. And I want to thank Andrew and his team behind the camera, doing the voice, the video control, and all the technology that I don't understand that makes this streaming event happen, hopefully smoothly. And yeah, thank you again, and looking forward to seeing you at a future event.